Depending on who you listen to here on YouTube or watch on TV, you'll get all kinds of answers to the question, what is the best way to invest?
Top 3 dividend stocks that I think that any dividend investor should have as the foundation of their portfolio.
And those 2 picks are Amazon, which tends to gain share during a recession.
Just buy an index fund and never look at a headline, never think about stocks anymore.
Now, investing is complicated enough already before you have to choose what to invest in. And that's why in this video, I'm going to go through the pros and cons of a few different styles of investing. Dividend stocks, growth stocks, and index funds. And hopefully, by the end of the video, you'll be in a much better place to make the best decision that's right for you. Let's start with dividend investing. Now, this is an investing style that's really popular here on YouTube, and many people find out about investing like this through videos on the topic of passive income. The idea is simple. You buy shares in companies that pay dividends, which are payments of cash given to shareholders. The more shares of a company you own, the more dividends you'll receive. And if you have enough shares, you can even use the dividends to pay your bills and maybe even never work again. For example, let's say you own a company like Coca-Cola, which is one of the longest running stocks that pays a dividend. Right now, the dividend yield is 3%, and this is the percentage of cash that you'll get paid each year, depending on how much money you have invested. So let's say you have £100,000 or $100,000 worth of Coca-Cola shares. 3% of 100k is 3k, and this is how much you would expect to be paid in dividends each year. Now, if you look at how often Coca-Cola pays a dividend, you'll see that it's quarterly, which is every 3 months. Therefore, if you divide your 3,000 by 4, you'll get 750 every 3 months. Sounds pretty good to me, and you can see why lots of people like to invest this way. It's about as close to a passive income as you can get because all you need to do is own the shares and you'll get paid. Now, dividend investing is also popular because companies that pay a dividend tend to be larger, profitable, and well-established ones. The idea is that as a company ends up getting really big and generates lots of cash profits, they have nothing better to do with the cash, so as a shareholder, you are entitled to your share of it. So rather than a company decide what to do with the money, they give it back to you as the shareholder, and then you can do whatever you like. Sounds great. And you could argue that this is what being a shareholder is all about. It's your money and your company, so you should be given the cash if a company doesn't need it to invest in for anything else. Also, over the long run, if you buy dividend stocks, the idea is that you can also buy more of the same shares with your dividends. You might hear this referred to as the DRIP strategy, which means dividend reinvestment plan. And if you can do this for many years, you can end up with loads more shares in the same company, which, if you're following along, should also mean that you get bigger and bigger dividends. Then once you're ready to start taking the dividends and not reinvest them, they can end up being your passive stream of income, which pays for all your bills. All sounds good in practice, but just before you get carried away and go all in, I do need to run through some of the cons because it's not all candy floss and rainbows out there. Firstly, if you only invest in stocks that pay a dividend, you're going to miss out on so many other companies that don't pay a dividend. Think about some of the biggest companies in the world like Amazon, Google, and Tesla, who've all given their shareholders huge amounts in gains over the years, but don't pay a single penny in dividends. Check out this stat here. Of all of the stocks listed in the US, which is currently around 13,400 companies, only around 2,400 paid a dividend. So that's around 18% of stocks that pay a dividend. But more importantly, 82% of them don't. Now, I don't know about you, but I definitely don't want to invest and miss out on 82% of stocks just because they don't pay a dividend. That's a pretty quick way to end up doing badly as an investor. Also, on that same topic, we have to remember that a dividend is not some magical free money. It's part of your return as a shareholder. But it's not the most important thing in investing, which is total returns. Without going into too much detail, remember that as soon as a dividend is paid, that money gets removed from the share price because the value of that company has been reduced as there's less money in their bank account and more money in yours. So as an example, let's say a company has a share price of $10 and they pay out a $1 dividend per share. On the day they pay that out, the price of the stock will fall to around $9. There's no free money here. $1 plus $9 gets us back to the $10 total value. So just bear in mind where your dividends come from, and don't forget about taxes too, but that's a whole different video. Every time a dividend is paid, you are liable for taxes unless you're using some kind of tax protected account, and that applies whether you reinvest it or not. And then finally, here's another thing you need to know about dividend stocks. If you're a long-term investor like me and want to invest your money so it's worth more in the future, let's say over the next 10, 20 or 30 years, all you care about is the total return. You want that number at the end to be as big as possible, and I'm sure you don't really care how it gets there. Now, let me show you something about investing in dividend stocks that could switch a light bulb up in your head. If I look back over the last 10 years and ask the question, how many dividend stocks have outperformed the market in total returns? So that's saying even after paying a dividend and reinvesting it over 10 years, how many companies have actually done better than the market average, or at least beaten the returns of the S&P 500. Out of the 22,500 companies listed in the US and in Europe, only 1,800 have beaten the market. So I make that 8% of companies who've done the same or better than the market? Not bad. But what about those companies who paid a dividend? Well, of those 1,800 companies, how many paid a dividend of 2% or more? Just 564. So I make that less than 3% of all companies who paid a dividend managed to return more than the market average. The lesson here is that although some companies can pay a dividend and grow at the same time, you still have to get really lucky when picking the right ones. Unless you want to lose money, but then hey, I'll leave that one up to you. Okay, let's talk growth. After all, this is what investing is all about, right? Putting your money into companies that grow super quickly and then see their share price rise up to the moon and beyond. Then you hang on for dear life and think about what colour your Lambo is going to be when you finally sell some of your shares. Personally, I don't really like the name growth stocks, but let's run with it anyway and see where it takes us. So what is a growth stock? Well, I guess any company that's growing, but at least a bit faster than what you might consider a slow growing stock. So, I don't know, let's say companies that might be growing their sales by 10% or more every year. And those stocks that can keep growing for a long time because the market they sell into has huge potential. Over the last 20 years, you could say that technology stocks have been the growth stocks to be in. Again, we think about examples like Amazon, Nvidia and Tesla, alongside pretty much all of the rest in that space. These companies will typically reinvest a lot of their profits to allow them to keep growing faster and faster. This might be used to invest in research and development, or maybe even hiring more and more people to help sell their products. Everything they do is all about getting bigger and bigger, and not always about looking good this year or the next one. Now, while this can be a really good thing and people love to see a company growing, it can also have some major issues because things can change really quickly out there in the market. Just think about all of the companies that went bust or struggled over the last few years. Loads of so-called growth stocks went public in 2021, but very few survived. And many were only able to survive because interest rates were so low and it was really cheap to just keep borrowing money and burning it. The idea was always that it was okay to keep spending money now, as long as sometime in the future they finally found a way to make some money and become profitable. Unfortunately, as we all know, things turned around very quickly in 2022, putting lots of people out of business and causing a huge amount of pain for investors in those companies. However, even after picking up on those negative points, let's not forget that some of the biggest companies in the world could still be considered growth stocks. If you just take a look at the largest companies in the world, companies like Microsoft are a good example of a growth stock, even though it's already worth almost $3 trillion alone. People expect a company like Microsoft to keep growing year after year, especially in areas like cloud computing, because that market is getting bigger and bigger each year and the demand is huge. Then just think of another example, the best performing stock in the market ever, Monster Energy. A company that's delivered more than 72,000% gains over its lifetime, beating pretty much everything else, and it's not even a fancy technology stock. Now, this makes you realize that if you do want to have a balanced investment portfolio, surely you'd want to have a mix of growth stocks and dividend stocks because you wouldn't want to miss out on huge returns like Monster Energy. This company's never paid a dividend and it might never pay one in the future. Also, not to mention that there's loads of other types of stocks out there too, but I really don't want to make a video covering all the different kinds because we'd be here for hours. Now, the big question to tackle here before we move on to index funds is, how do you go about picking the best growth stocks to invest in? Remember, as I showed earlier, less than 3% of all stocks that paid a dividend actually beat the market. So in total, that's the number of stocks that produced more than 12.7% on average every year for the past 10 years at least. If we include all stocks that don't pay a dividend as well, we get to that total of around 7.7%. meaning that around 4.7% of all other kinds of stocks are the only ones that beat the market over 10 years. To me, that's a pretty frightening statistic, and one that I think if more people knew about, would probably stop so many people wasting money gambling on terrible companies which have no chance making it. On second thoughts, to be honest, I don't think people will ever stop gambling on stocks and trying to guess the market, because there will always be some people out there who win massively and shout about it online, making everyone else think that they can do the same. Okay, let's move on to index fund investing. The whole idea of this style of investing is that you buy one investment, like a mutual fund or an ETF, that tracks the whole market for you. Inside that investment will be hundreds, if not thousands of companies, and they'll be ordered depending on their size, which is called market cap weight as a technical term. Basically, the larger the company, the bigger the share of the fund that gets allocated to it. Everything's done automatically, there's no stock picking going on, and this means that over the years, the bad companies get kicked out and the bigger ones are just left to grow. There's actually quite a lot of different indexes, which can get quite complicated if you're a beginner, but some of the most famous and popular ones would be like the S&P 500 in the US, the FTSE 100 here in the UK, or even something global like the FTSE All-World, which invests all over the world. Index fund investing has many benefits because you get companies from lots of different industries, so you have a good level of diversification. There's no worries about one company going bust and losing all of your money if you were picking stocks. You also don't have to worry about choosing the right investments, which can save you a huge amount of time. It's also super low cost to do it. I mean, have a look here on something like a FTSE All-World ETF, which you can find on platforms like Trading 212 or InvestEngine that I use. The fees to hold this fund work out to be just 0.22% a year. So for every £1,000 you have invested, your costs are just £2.20 per year. Now, I don't know about you, but that's pretty cheap, and there's not much you can really get for £2.20 these days. Also, just on that note, I do keep the links below to the platforms that I use below, where you can get free shares and a free cash once you sign up and deposit. And thanks to the many hundreds of you who've used that and continue to support the channel. And finally, most importantly, the reason index funds have become so popular is their performance. I've just shown you how difficult it is to pick the right stocks, and this isn't going to change anytime soon. Most companies end up going bust, bankrupt, or sold in some way, and very few last for more than a few decades because it's really hard to stay at the top of your game. An index fund means that you don't have to worry about any of that and spending your time trying to work out which ones to invest in. But the absolute best bit is that index funds have beaten the majority of retail investors and the majority of professional fund managers who charge a fortune for their so-called expertise. Let me show you here, and JP Morgan published this one regularly, showing just how badly the average retail investor does, with an average return of just 3.6% a year. It's no wonder when most people have no idea what they're doing and just trade in and out of stocks thinking they're some kind of genius after watching some of the grifting gurus here on YouTube. Just look how bad this is when compared to even bonds. But the real kicker is this green bar. Here's the S&P 500 and what an investor could have got if they just used a single index fund and never did anything else but just kept buying. Now, there are no guarantees ever in this game, but what would you rather do? Bet that you're investing genius and can find the small percentage of companies that beat the market, or just buy the whole market and never have to worry again? None of us know the future or what will happen, and truly, the most important thing is finding a way that works for you. It could be one of these, all of them, or even some kind of different mix. All that really matters is finding something you can stick with, and that, in my view, is the best way to invest. Anyway, I know what I'm choosing, and you can see this on my channel where I share all of my investments, and the majority will always remain in low-cost index funds that are invested all over the world. But hey, that's just me. I'm not a financial advisor, I'm just doing my own thing. And yes, before you ask, I still do let myself play around with a few stocks on the side, and I've even got some crypto too. I'm not immune from tinkering around, and I'm only human. Now, if you're still confused and need help finding the right index fund for you, then my latest video might be the one you need. It shows you the top Vanguard index funds I think are the best to buy now this year. I'll see you in the next video. Happy investing.